SpaceX is about to go public with an IPO at $1.75 trillion, while losing $5 billion a year. So who is actually buying at that price? Here is what nearly everyone gets wrong. The biggest buyers will not choose to invest. They will be forced to, your retirement fund included. The index rules making it possible were quietly rewritten weeks before the offering. And the company Wall Street thinks it is buying is actually three very different businesses duct taped together. Start with the elephant in the room. XA. SpaceX is slapping a $250 billion price tag on this division, more than the combined value of Coca-Cola, McDonald's, Disney, Nike, and Starbucks. For what exactly? Monthly cash burn is north of $1 billion. That is not a typo. That is $1 billion going up in smoke every 4 weeks, with revenue still stuck in the single-digit millions of dollars. It is like setting fire to a pile of cash the size of a regional bank every month and calling it innovation. Now, take a look at the leadership board, or what is left of it. 11 co-founders walked out the door. Gone. Linda Yaccarino, once the face of X, quit after the Grok fiasco. The CFO and general counsel both resigned by September. Igor Babushkin, a founding researcher, bailed in November to chase AI safety somewhere else. Even Musk had to admit, I needed a rebuild. So why does this matter for the IPO? Because XAI is not just a side bet. It is the main reason SpaceX's losses ballooned to $5 billion last year. Rockets and satellites cannot plug that hole. Investors are being asked to pay luxury car prices for a division that is burning cash faster than any AI startup on record. The question is not whether XAI will ever justify a $250 billion valuation. It is who is left holding the bag when the music stops. And thanks to index rules, that might just be every passive investor in America. Rocket launches. The bread and butter of SpaceX's public image. Falcon 9s, Starships, boosters landing upright. Spectacle, sure. But let's talk numbers. Last year, rockets pulled in about $4 billion. That's not a typo. $4 billion in launch revenue, according to the S1. Now take a breath. That's just a quarter of SpaceX's total haul. The rest, not coming from rockets. Who's paying for these launches? NASA, yes, and a handful of commercial satellite operators. But government contracts make up the lion's share. The customer list isn't exactly growing at the speed of a Starship launch. Most of the world's payloads are either government-funded or one-off commercial satellites. The pool isn't getting deeper. Here's the kicker. Even if SpaceX doubled its launch business overnight, the math doesn't budge. $4 billion is respectable for a rocket shop. It's not the foundation for a $1.75 trillion empire. That's why the company's pitch leans so hard on Starlink. Rockets are a solid business, just not a mega-cap business. Investors banking on launches to justify this IPO might want to check their calculations. So if rockets can't fill the gap left by XAI's bonfire of cash, what does? The answer is sitting in orbit, beaming internet back to Earth. But before we get to Starlink, ask yourself, if the rockets aren't enough, why is everyone so eager to buy in? Maybe it's not the business fundamentals at all. Maybe it's the index rules doing the heavy lifting for passive funds. Starlink is not just a side hustle. It is the main reason SpaceX can even pretend to play in the trillion-dollar leagues. Let us get specific. Starlink pulled in $11.4 billion last year. That is 61% of every dollar SpaceX touched. Not launch contracts, not moonshot AI, just satellite internet beaming down to more than 10 million subscribers across 150 countries. The service runs on a constellation of over 10,000 satellites, the largest fleet ever assembled. And here is the kicker. Starlink's profit margin clocks in at a jaw-dropping 63%. That is not just healthy, it is pharmaceutical level. Apple level, pick your favorite cash. Machine level. The satellite business is spitting out over $7 billion in operating profit, enough to fund rocket launches, pay for AI experiments, and still have billions left over. But let us not get carried away. Even with all that cash, the company still posted a $5 billion net loss last year. Starlink is the hero of this story, but it is not a miracle worker. It props up everything else, keeps the lights on, pays the bills, and covers for XAI's bonfire. Yet the numbers do not lie. You cannot beam away a multi-billion-dollar hole just because one division is printing money. So why are investors lining up to buy? Maybe it is not Starlink they are chasing. Maybe it is the promise of automatic demand baked into the rules of passive investing. May 1st, 2026. Nasdaq rewrites the rulebook, and it is not subtle. The timing is right on cue for SpaceX's debut. 3 changes, each one designed to grease the skids for a mega IPO with a float the size of a rounding error. First, the fast entry rule. Forget the old 3-month waiting period. Now, any newly listed giant can waltz into the Nasdaq 100 after just 15 trading days. 2 weeks and a day, barely enough time for the ink to dry on the S1 registration. Nasdaq's global head of index solutions, Cameron Lilia, spelled it out in the filings. He wrote that the waiting period is trimmed from 3 months to 15 trading days. No more seasoning, no more suspense. If you are big enough, you are in immediately. Second, the float rule is gone. Previously, a company needed at least 10% of its shares freely trading to get index access. That is history. Now, a company can show up with a float as low as 4 or 5%, just enough to stage the IPO and still get the full index treatment. Reuters called it removal of the 10% float rule. Nasdaq's own FAQ confirms the shift. Market cap now includes unlisted shares, so the float can be wafer thin, but the index will pretend the whole iceberg is above water. Third, the multiplier math. Here is where things get fuzzy. The filings do not spell out the formula, but the word on the street is that stocks with less than 20% float get their weight tripled for index purposes. So a 5% float is treated like 15%. Officially, Nasdaq will not say it out loud, but the effect is real. Low float giants get a bigger seat at the table than their tradable shares would ever justify. Put it together, a company can go public, offer a tiny sliver to the market, and thanks to these new rules, get jammed into every major index fund almost overnight. The timing is not a coincidence. It is a regulatory green light just in time for SpaceX. The next numbers to watch are how little float is actually hitting the market and how much passive money is forced to chase it. June 4th, the SpaceX IPO roadshow kicks off. By June 12th, shares hit the Nasdaq. Mark your calendar, because if you have a 401k, your money is about to be put to work, whether you like it or not. Here is how it plays out. SpaceX is dangling a $75 billion raise, but only offering up a sliver, just 4 to 5% of the company's shares. That is the entire public float. For a business aiming at a $1.75 trillion price tag, it is like selling the tip of the iceberg and pretending the whole thing is up for grabs. But it gets better. Of that tiny float, 30% is earmarked for retail investors. That is right. Nearly a third, according to CFO Brett Johnson, who calls retail buyers incredibly supportive. Translation: Main Street gets a big seat at the table, but it is still a game of musical chairs with far too few chairs. The rest goes to institutions and a 5% employee pool. But the real show is what happens next. The IPO calendar is locked in. June 4th, roadshow. June 12th, shares start trading. June 22nd, quarterly rebalance. That is when every index fund tracking the Nasdaq 100, think QQQ, think your retirement plan, will be forced to buy in no matter the price. The float is wafer thin, but the rules say funds must own their slice, even if it means chasing shares at nosebleed valuations. No waiting period, no float minimum, no escape hatch. Just a wall of passive money, all hitting at once. The mechanics are not abstract. They are a trapdoor. Your index fund does not get to ask questions. It just buys. And with so little stock available, who do you think sets the price? Not you, not your fund manager. The seller staring across the table knows exactly how desperate the buyer is. That is the real risk. Automatic demand, zero negotiation. When the dust settles, every passive investor owns a piece of SpaceX at whatever price the market could bear in that frenzy. Still think passive means safe. Right now, Wall Street is set to funnel trillions into a company worth more on paper than Disney, Nike, Coca-Cola, McDonald's and Starbucks combined. But ask yourself, are you investing or just along for the ride? In this game, passive doesn't mean safe. Think it over.